Hi everyone, so today we'll be covering Sprouts, the farmer's market. It's a supermarket that sells organic foods. It's a competitor to Whole Foods, so let's get right into it. Let's see for what's happening with Q2 2025. All right, so just take a quick look here. July 30th, 2025 is when it came out for Q2. The earnings were quite good. They beat expectations for both analyst expectations for both revenue and earnings per share. Their net sales came in at 17% increase, 2.2 billion, really good. Comparables same-store sales growth came in at 10%, 10.2%, which is really good again. Because if you know, I cover Chipotle on this channel, and Chipotle is not even growing. I think they're slightly down for same-store sales growth, so really good on that metric. EPS, diluted EPS or EPS, is coming in at $1.35, which is the consensus estimate of $1.23. This also marked a significant 44% increase from the 94 cents reported in the same period last year. Really good. Net income is 134 million. E-commerce sales growth is also growing. And if we check here, full year 2025, following the strong performance, Sprouts raises guidance. Net sales growth forecasted to be 14.5% to 16%. Comparable store sales growth anticipated to be 7.5 to 9%. Diluted EPS to be 5.2 to 5.32. Unit growth, company still opens to plan at least 35 new stores by the end of the year. And keep in mind, the company opened 12 new stores during this quarter for July, bringing its total 445 locations across 24 states. So looks really good overall, I would say. Can't complain here. Now, if we check Simply Wall Street, it's going to be okay. So we have free cash flow currently of 502 million. In the next 3 years, it's going to be 717 million. So it's not a billion, it's not doubling. So the growth is definitely slowing. Now, if we take a look from the previous few years, in 2022, we'll dial back the clock, it was 280 million. And in 3 years, which is 2025 now, it's 502 million. So it didn't even double. It was close to it as well, but you could definitely tell that growth is starting to affect it, and it's starting to slow down now as well. However, if we check the financial health of the company, it's quite good. Now, they're finally out of this debt, really. They paid off all their debt. They have high cash and good equity. So there's no complaints from me here. They executed this perfectly. They're not going bankrupt anytime soon, it looks like, so it looks very good overall. No debt, so just clarify that. If we check my DCF on it, my DCF is going to say it's undervalued by 1%. So it's pretty much efficiently valued right now, and that was Wall Street. If we check historical growth, it's overvalued by 3%. I think it's officially valued currently at this price. So take that as you will, but you're not getting in any cheap. It's just fairly valued. That's all it is. Now, if we check, and I have to keep loading this up, but this is Tipranks. Let me reload it quickly so people will take a screenshot. But it's a moderate buy. I'm going to reload it again. It's a moderate buy with 6 buys, 7 holds, 13 rating. But the upside, just to reload it again, is tremendous. It's about 46% upside. So I would say overall, the company does look quite good. And keep it on your watch list. I'm going to cover for Q3. But just be cautious that the growth isn't going to be as high as it once was. All right, thank you, everyone. I appreciate it.